Hey everybody, this is Bob, a trade genius. Got my good friend Phil here. The bond market knows everything and is ready to teach us another lesson. Stay tuned.
Trade Genius.
Hey everybody, it's Bob with Trade Genius. Usually I do fun ads. I talk about our service, but I want to be serious with you for a second. We've been helping a lot of people trading for a long time. As you can see here, I want to let them do the talking for me for a change. But most importantly, we want to help you too. If you have not joined our service yet, come check us out, tradelikeagenius.com. Full service. We have chat room. We have the algorithms for you. We give trades out every day. We educate you. So go to tradelikeagenius.com. Check us out. What you get out of our service is much, much more than what you put into it. And we'd like to see you in the room. Thanks for listening. Okay, Phil, alarm bells should be ringing in the village square here because something is happening in the bond market that's going to have profound impact on your ability to make money in the markets. What say you?
Yeah, and we have an awesome signal that is just about triggering here. So let's take a look at what that is. This is the 3-month bond yield. And actually what it is, it's the 10 weighted moving average with the 50 weighted moving average. So they're just moving averages of the actual yield itself, which isn't plotted on this chart, but that doesn't matter because you just want to know when these moving averages cross. You could look at this as like a death cross. And what that's telling you basically is it's just giving you confirmation that the yields are rolling over. And the reason why they're rolling over is because we're getting a rotation into bonds. If you are buying bonds or the bonds are going into a bull market, then the yields drop, and vice versa. If nobody wants bonds, they got to crank the yields up to attract investors. Why does that matter? Well, when we have this trigger on the moving averages here on the 3-month government bond yield, it's a great indicator of trouble in the economy and specifically recessions. So if you look on this chart, starting from the left, when we had our death cross, if you will, that was the dot-com era, that bust there, we can look at the AI bubble as a similar situation. Next time we saw it was the subprime era with all of that contagion that flowed all over global assets. And then we come forward to COVID. And again, we're just looking at the levels that are up here in the 2.5 and higher area. And you look at that crossed over right before COVID for a trigger as well. And here we are again, kind of right before we get into this blow off phase of the market that we expect to happen. And then we look for potentially rolling into a recession toward the end of the year. So this signal is extremely accurate, and it's accurate because this is the way the institutions handle when the economy slows. They rotate into bonds. And for everyone thinking that, things like, stocks and crypto are just going to keep going, well, that's just not the way it works. I hear a lot of arguments like for Bitcoin, as an example, the ETFs have changed everything, right? And then it's never going to really go back down, but that's just not how it works. These ETF flows will reverse, and then money will flow out of those because their wealth advisors are telling them, hey, you got to get into bonds because that's the safety play going into the next 12 to 18 months. So this is a very accurate signal for a lot of reasons, but if you ignore this, and again, this can take 1, 2, 3 months to really start to play out and have this rotation take place. And that's why we've been pounding the table, Bob and I have, on watching TLT or even the TLT/SPX chart, because that thing's been in a terminal decline. But those terminal declines, once you break that trend, that's usually confirmation that, hey, the rotation has started. So this is your first heads up though, Bob, that it's coming.
Yeah. And I think what this is showing us too, we're going to show you a couple charts here in a second, is this is known as a potential bull steepening move. Mm-hmm. Now, before people think bull, like bull market, stock market, it's actually bond bull steepener. And we have some explanations here for you. It's a bit of an eye chart from me here, but Phil can read it here. Basically, when you have a steepener, a bull steepener, is that the short-term rates are falling faster than the long-term rates are. And that's the situation we're in now. And we're going to move from a bull steepener then into a bull flattener. And then that's when really all hell breaks loose. So let me show you the next chart. This chart here, it kind of gives you what to buy in these situations. So if we go into a bull steepener, if you notice, materials, yes, they've been doing well. Healthcare, yep. Staples, yep. Financial services, yep. Technology has been doing okay too. And so that is the trade that's probably being promulgated right now, Phil. And you could see it. I mean, look at XLB, look at, USO, look at ExxonMobil. They're all just flying. Copper's flying right now. And then when we move into the bull flattener, then that's when everybody's really going to start to lock down, and you're going to then get, basically defensive names happen, and that's when people expect the first rate cuts. So we're in a really weird situation. Powell does not want to cut rates, okay? But the market usually leads Powell, the Fed. So the Fed never leads. The Fed always follows. And I think money's starting to rotate out of stocks. People are getting nervous. This move has been incredible. All the rich people are moving out of the stock market, and they're going to force to move into the bond market. And so watch that crossover, and we'll talk about it as it happens. And then the second thing you watch for is TLT to start reversing against SPX, and then to get fully defensive. But it's always smart, to not be the last person at the party, right? So you need to start positioning yourself, well ahead of this move. We got a little bit of a scare on Thursday, and I think the market, you can see how fast the market could just turn off. And I think people really need to start understanding that. If we don't get a war today or tomorrow, in Israel, the market's going to probably start off the week higher, Phil. But this is more macro. This is telling you that money that is smarter than you is leaving the stock market and going into the bond market. So you don't want to be the last man standing in this environment.
Yeah, and then if we look at where the status of the yield curve is here on this next chart, you guys will see that we've been in this bottoming process for a while. That's where this green shaded area starts, and this green shaded area extends out to about October of 2025. And the reason for that is because that's about the time it takes from when you bottom on the yield curve inversion to where the eventual bear market would play out. And we have in red here kind of just like a projection of what we think how this might play out. So we got some time yet for this market to roll over. I'm not saying that it's going to look exactly like this projection here, but more or less it rhymes. And we are expecting more highs to kind of finish the move off here. But you'll notice up here, the yield curve inversion, it's been chopping sideways and chopping sideways. It's starting to tick up, and it's starting to tick up coinciding with that signal that we showed you guys on the 3-month. This is something we're now watching probably week to week, because as this rotates up and hits, the zero line and then starts to go into yield curve normalization, meaning that it's going to be positive, then that's where typically at that point, you're looking for the market to no longer go up, and you're looking for the recession trade to take hold, which is rotation into bonds out of risk assets. So we're not there yet. Obviously, we got time, and some of the other metrics in the economy haven't really hit those levels yet either. So this can still go some more, but it's pretty obvious to me that the barge or the oil tanker is starting to turn.
Yeah, and look, once that inverts, there's a 100% win rate on that tops the market, and you have essentially a 2-year bear market showing up. So if you don't listen to the 3-month, and if you don't listen to the SPX TLT, definitely listen to when the yield curve inverts, because everybody and their brother will be bailing out of stocks, and it's it's an Alzheimer kind of move. It's the long goodbye. 2-year bear market, and it's tying right up with the first year of a new presidential administration or a new term in service if Biden gets reelected. And usually that first year of a presidential cycle is the most bearish. And so things are just lining up everywhere you look. The stars are aligning, Phil, and you're getting a lot of time here now to prepare yourself. So we don't want to hear in the room that people were surprised when this market is starting to just grind you to death. You want to be sitting fat and happy in the stuff that's going to go up when that happens.
All right. Well, thanks, Bob. Guys, thanks for watching. Please hit like and subscribe. Let us know your thoughts on this video. Please post your comments below if you agree or disagree. And if you need help navigating this market, head over to tradegenius.co. We've got a ton of specials that you can choose from, and you can get into the room with Bob and I. We'll see you guys on the next episode. Have a great weekend. Talk to you later.
Trade Genius.